What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I have 3 dividend stocks you guys wanted me to review. They're terrible, and you guys wanted me to do a review on them. I'll provide a counter example at the end, but these are dividend investing mistakes that real estate investment trust, avid real estate investment trust investors like myself can fall into if they don't do their digging. So I'm going to go over this with these 3 dividend stocks. I'm going to provide you examples of what can happen if you fall into a dividend yield trap or a yield trap stock or real estate investment trust. And I'm going to go over a counter, like I said, a counter example on a real estate investment trust that is the same as these 3 dividend stocks, but is doing very well. So I'm going to give you my tips on how to spot good ones. Again, this is not financial advice for entertainment purposes, only disclaimer in the description. I love high yield dividend stocks, high income dividend stocks. I'm going to use that to buy my dividend growth stocks. So it's like I'm putting money in the bank and then I'm reinvesting the dividends into dividend growth stocks like Starbucks or Huntington Bank shares or Key Bank or Key Corp. So that's what I plan on doing with my dividend investing strategy. So I've posted numerous videos for you guys on dividend stocks I love and I'm buying. There's always a risk when it comes to dividend investing. There's risks of dividend cuts. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. Let's check these REITs out right now. So the first dividend stock I'm going to go over is Orchid Island Capital. You guys wanted me to do a review on them. The one thing that's a big red flag is their price per share has done terrible against the S&P. So that's one big red flag. This is one that you guys wanted me to really do a review on because of the recent news. I don't even see a PE ratio on here with Google right now. That's a red flag. And again, PE ratio is not the important thing when it comes to a mortgage-backed real estate investment trust or a real estate investment trust. FFO is /AFFO. That is important. So that's another thing people fall into is PE ratios when it comes to real estate investment trusts. Now their average volume is 1.23 million. The market cap is 357.62 million US dollars. Year range was 795 to 2425. That is a huge dip. Day range was 1049 to 1082, and its previous close was 1057. So let's look into these guys real quick. So I'm doing a review and going over dividend investing mistakes that people make. So let's check these guys out. So Orchid Island Capital is a specialty finance company that invests in residential mortgage-backed securities on a leveraged basis. Income is generated for distribution to our shareholders is based primarily on the difference between the yield on our mortgage assets and the cost of our borrowings. We operate to qualify to be taxed as a real estate investment trust. Remember, 90% of what they make go back to investors for federal income tax purposes and generally will not be subject to U.S. federal corporate income tax to the extent that we currently distribute all of our REIT taxable income to our stockholders. We intend to operate our businesses in a manner that permits to maintain our exemption from registration under the Investment Company Act. Okay, so they're managed and advised by Breamy Advisors, blah, 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 blah. They're sitting at 1072. Now, let's look a little bit more into these guys. Okay, so here's the revenue in millions US dollars. We need to see, when you look at a real estate investment trust, you want to see good revenue and revenue increases. So right here, 2015, this is in millions US dollars, 68, 2016, 87, 2017, 145, 2018, 154, 2019, 142, 2020, 116, then 2021, 134. But let's go a little bit more in depth with these guys revenue-wise. December 2021, the revenue was down 40.2 million. The net income was down 44.56. Net profit margin was up 110.86%. So that's December 2021. And then basically it was down 308.53%. So then we jump to March, it's down negative 144.03 million. Still down. I mean, look at this. Operating income's negative 148.73 million. Net change in cash is negative 23 million. So net profit margin was 103.26. It was down 9.02%. And then we go to June, it's down a little bit, 55.2 million. And then net income negative 6.14 million. So we see some problems here. Operating income is down, negative 60.14 million. Net profit margin was down. Okay, so they owe a lot. They're not making money right now. Net profit margin was up 106.58%, which is good. The revenue was down 79.3 million. Net income was down 84.51 million. Net profit margin, sure, it's up, but we got some problems. So now we're going to go over their dividend history, and we'll go over the recent announcement with these guys. So let's start in 2014. They were 18 cents a monthly dividend. 2015, 18 cents. Then 2015, they dropped down to 14 cents. Yikes, no dividend growth. Then 2018, 11 cents. Then 2018, 9 cents. Then 2018, 8 cents. 2019, still stagnant, still 8 cents. 2020, 6 cents. And then 7 cents. Okay, the pandemic, you can blame that. 7 cents. Still 7 cents. Then it's down to 6 cents in February. And then 5 cents in August. Wait a second. There's 16 cents. We're going to go over that. The payout ratio is 65%. Number of dividend increases in the last 5 years is 3. Annualized dividend growth in 5 years is negative 18.02%. The yield right now is 18.17%. So, and then if you bought one share, you made 192. But why did it jump from 5 cents to, is that 5 cents? Of course, the ad's jumping away. 5 cents to 16 cents. Let's look at that. Come on, stock split history. A reverse split, meaning each 5 shares of ORC that you own, the shareholder now own 1 share. For example, if you had 1,000 shares pre-split, now you have 200 shares. So a reverse share split or a reverse stock split is a huge red flag. That means they got issues and they're trying to be attractive to investors so that they try to keep their name in line and people aren't selling them because they realize that they're a problem. So when you see a reverse stock split, I run away. I stay away from them. You know, there's a big dip that happened during the pandemic. Many people capitalized on it. Good for you. You know, I can understand if you're holding on to the shares because you bought so many shares and you're making passive income, but there's a decrease in dividend income and slash passive income in monthly dividends. Another thing you need to be aware of that a lot of dividend investors make mistakes with is they look at like all of a sudden these quarterly dividend stocks become monthly dividend stocks and they're like, oh man, monthly dividends. But it can be a yield trap because if you look at my previous videos, as I showed you some of these stocks, I'm pretty sure you can don't quote me on this. You can correct me if I'm wrong, but Capitella Finance was quarterly. Then they changed to monthly. And I'm going to provide to you an example of a quarterly dividend stock that changed to monthly, and they're a yield trap as well later in this video. So now let's jump to the next dividend stock. And here's another one that I actually bought the dip big time, try to make some money and earn a little bit of passive income because there's no way that they would have rebounded. So now I'm going to go over this. It was not 182.30 and it was not at the time 1950. So we'll go over that, but if you notice that there's a decrease in price, it was right here 40.60 in June 25th, 2021, and it's now 13.10. So let's just say January 14, 2022 is 28.10 to 13.10. In Invesco Mortgage Capital, it has a dividend yield of 19.85%. The average volume is 761.65K. Market cap is 463.47 million US dollars. Its year range is 960 to 3150. Its day range is 1305 to 1340, and its previous close was 1321. So we're going to go over these guys real quick. So right here, I'm on their website, in Invesco Mortgage Capital, they take an opportunistic approach. They consider a broader spectrum of opportunities to deliver a more diversified portfolio than most managers of mortgage REITs. We'll see. Our external management team performs detailed analysis at the security, loan, and property of the borrower level. We employ comprehensive risk management with specific elements integrated at each step of the investment process. Their portfolio consists of macroeconomic and capital markets analysis, mortgage sector analysis. They do security level analysis. They do formal investment committee decision making and transaction management. So this is the thing. They perform meticulous analysis of loans, properties, borrowers, underwriting, and bond structure. So in the mortgage sector analysis, they identify opportunities and trends in the agency basis, prepayments, credit sector basis, and asset funding sources. So right down here, IVR, they seek to embrace emerging opportunities and avoid developing market risks and weaknesses. In their current environment, we are finding emergent opportunities in secured residential loans, commercial real estate and loan origination, and risk-sharing arrangements with federal housing authorities. So they seek to deliver attractive competitive returns with consistent high dividend income and stable book value. Now, I like high dividend income. Don't get me wrong, but there's a little bit more digging that needs to go into these guys, and we're going to check that out. So first, looking at their income, this is one thing that I look at when it comes to real estate investment trust, is consistency. 2015, this is in millions of US dollars, 650, 2016, 478, 2017, 545, 2018, 643, 2019, 778, 2020, blame the pandemic, 280, and then 2021, ouch, 169, 202. Now we're going to look at their dividend history. We need to look at their dividend over time. So this is 2011 in April, $1, and then it was 97 cents, and then October is 80 cents, then it dropped down to 65 cents. Then 2012 it jumped to 48 cents. Then it jumped to 65 cents in 2012, 2013. Then it jumped to 50 cents in 2014. Then 2015 it jumped to 45 cents. Then 2016 it jumped to 40 cents. In 2017, we were starting to make a comeback, 41 cents. This is what I like, is comebacks, 41 cents, and then 42 cents, and 48 cents. And then 2018, it was 42 cents, then 45 cents, then 50 cents. Then the pandemic just, boom, killed these guys. I mean, just tore them up. Look at this. In 2020, 5 cents, then 8 cents, then to 9 cents, then to 90 cents, then to 65 cents. So we have a payout ratio of 72%. The number of dividend increases in the last 5 years is 7. Dividend growth in 5 years was negative 38.71%. So if you bought one share, you made $260 with a 19.70% dividend yield. Now, I bought these guys kind of make a profit, and I threw some play money in there to see what happens with these guys. Now, here's the disappointing news about these guys in recent news. Invesco Mortgage Capital has a 1 split in their split history. The split for IVR took place in June 6, 2022. It was a 1-for-10 reverse split, meaning for each 10 shares of IVR owned pre-split, the shareholder now own 1 share. Ouch. For example, a 1,000 share position pre-split became a 100 share position following the split. So that's painful, okay? And I sold these guys just for another dividend stock after this. You know, I wanted to see what happened. It's just some play money to see what happened, because I bought a lot of real estate investment trusts and stocks that took a huge hit, specifically the real estate sector and financial sector. And, it is what it is. I'm not too worried. I wasn't, relying on these guys as a dividend stock. But, some of these guys make comebacks. Some of them have done very well. Some of them have rebounded strong. Some of them are just in bad shape. So I put some play money in there to see what happens with IVR. As I explained in my previous videos, it's a wait and see what happens. It's not a buy and hold forever thing. It's just let's see what happens. So they're getting hit hard. And before I jump to the final dividends stock, which I'm providing counterexamples as to the mistakes that people make with dividend stocks, let's check their revenue out in 2022. So now revenue-wise and why this thing looks out of whack with this stock on Google, which I'll jump to in a second. But look at this revenue. Negative 95.57 million. Net income down. It's down 275.85%. Revenue's down 246.47 cents. Net profit margin, sure, it's up 20.05%. Big deal. Revenue sucks. So that's a problem. Now, don't get me wrong. Maybe in the future I could buy them. But now you know why all of a sudden it looks like it's 178 and it drops. So all of a sudden, if you see a price like this that seems too good to be true, you know that it's a reverse stock split, which is bad. Stock splits are good if you're Apple and you're doing really well. Reverse stock splits are bad if you're companies like Invesco Mortgage Capital. Now let's jump to the final dividend stock that I have a counterexample, which is a dividend investing mistake people make. And here's another one with NLY Stock. You guys wanted me to review these guys, but here's the problem. People buy stocks because people post videos, and I tell you to do your due diligence, or people make posts on Twitter or Instagram. Oh, this is a great high yield dividend stock. I'll make a post on Twitter as a popular dividend stock because this is a popular dividend stock, but I don't like it. Not good. It's a problem. Dividend yields 16.67%. A PE ratio is 2.63. Remember that mistake. People look at PE ratios with REITs, but it's FFO and AFFO, which is important. The average volume is 7.83 million. The market cap is 9.88 billion US dollars. G range is 1511 to 3416. Its day range is 2062 to 2127. Its previous close was 2079. So you already know what this too good to be true thing is, because I already gave you a hint is why this price was so high in the beginning, and all of a sudden it seems like it's trying to rebound, but it ain't rebounding. So we're going to go over these guys as a company. So these guys, again, they provide investors to access to highly liquid agency mortgage-backed securities. That's another one. So we got problems. So here's their assets, funding. They look to be very presentable on their website, what they do and how they work. But let's check out their revenue. So let's start in 2015. Here's their revenue in millions US dollars. 1,135, 2016, 2,339, 2017, 2,808, 2018, 2,279, 2019, 882. There's a problem with consistency. The pandemic didn't even hit. Then 2020, it went down to 203. That's totally understandable. Then 2021, 2,836.21. So this is what raises a concern for me. Why isn't this going up from 2018 and 2019? 2020 is totally understandable. You got a pandemic. Now, again, this is not financial advice for entertainment purposes. Only disclaimer in the description. Please do your due diligence. I'm going to repeat that 1,000 times. But let's check out the recent revenue. You always have to check revenue trends with REITs. You have to be very careful. So let's check that out. And here's the recent earnings report with NLY. Revenue was down negative 229.65. Net income was down negative 275.26. Net profit margin was up 119.86. Yay! But guess what? All three of these are bad. Terrible. And then we're going to check out the recent news. So let's start with their dividend trends, and then we'll go to the news. 2010, 75 cents to 65 cents. In 2010, 68 cents, not bad. 2011, 64 cents. In 62, then 65. Then 2011, 60. Then 2012, 57. Then 55. Then ouch, 50. We're already seeing a decrease. 45, then 40. Then 35, then 30. Still at 30. Ouch. Got a little special dividend at 4 cents. And then still stagnant at 30. We hit 26 cents in 2016, but we're still stagnant at 30. And ouch, 2018, we're at 22 cents. And then they decided to give a 8 cents right there to try to make it 30 to compensate that. And then 30 cents. Wait a second, 2019, they're at 25 cents. Then 2020, they're 22 cents. A little stagnant. They're at 22 cents. So the dividend growth in 5 years is minus 8.10%. Number of dividend increases in the last 5 years is 1. The payout ratio is 78%. If you bought 1 share, you made $352 with a 16.93% dividend yield. Let's check out the news about these guys. September 23rd, 2022, a reverse stock split. Not a surprise. I posted numerous videos on these guys. The stock that is just rough. So the common cash dividend of 88 cents per share. But guess what? The reverse stock split is 1 for 4. So revenue ain't doing good. They're trying to attract investors, and that probably 88 cents will go down over time. So you just lost a bunch of shares for a reverse stock split if you praised NLY stock. That hurts. I'm going to show you one more thing that can lead to a dividend yield trap for you guys that you fall into, and you have to study the dividend trends. I'm going to do one more stock, and then we'll do our beautiful stock. So let's check that out. Another dividend investing mistake that dividend investors make when they go into REITs is they don't completely study the dividend history. Now, when you see a dividend stock, this one, AGNC, they go from a quarterly dividend stock to a monthly dividend stock. Now, anytime you see a quarterly dividend stock go to a monthly dividend stock, you should raise red flags. Now, you have to study the revenue. If the revenue is doing well, that's a different story. So I'm going to do the dividend history, and then I'll jump to the revenue. So 2014, it was 65 cents. Then 2014, all of a sudden they changed to a monthly dividend stock at 22 cents. 2015, 20 cents. 2016, 20 cents. They're stuck. Then 2016, they go down to 18 cents. They're still stuck at 18 cents. 2019, 16 cents. Pandemic happens, they're still stuck at 16. Wait, they're at 12 cents. So they go from a quarterly dividend stock to a monthly dividend stock, and they're decreasing their dividends. So I tell you guys, do your due diligence and study the dividend trends. Gosh, it's still stuck at 12. So your dividend growth in 5 years is 10.98%. Payout ratio is 46%. You bought 1 share, you made $144 with a 15.16% dividend yield. I'm going to provide an example of a quarterly dividend stock to a monthly dividend stock that is doing well. But we're going to jump to their revenue, and I'll give you the counterexample of one that's doing well. So look at this. This is revenue trends. I like growth. And if you get growth with revenue, especially AFFO is looking good, then you're going to get usual dividend hikes. The board of directors usually makes a call unless if something crazy and drastic happens. So consistency is key when it comes to monthly dividend stocks and dividend hikes. So 2015, millions US dollars, 1,466, 2016, 1,321, 2017, 1,293, 2018, 1,949, 2019, 2,842, 2020, ouch, 1,519, and then 2021, 1,361. So there's a decrease in revenue, but let's go a little bit further. Youch. Okay, it's 968. Net profit margin, 102.94%. Ooh, big deal. It's up 13.62%. But guess what? Diluted EPS is negative 1.31. Net income is down 666. Ooh, that makes me really want to buy it when you see 666, doesn't it? Revenue, negative 647 million. It's down 376.5%. Net income is down 414.15%. Diluted EPS is down. I had to stop and think. 474.29%. We got a problem. Now I'm going to give you a counterexample of a quarterly dividend stock going to a monthly dividend stock. So we're going to go over that. And my counterexample to AGNC is Agree Realty Corporation sitting at 70.28. Dividend yield is 4.10%. PE ratio 39.54. As you know, FFO, average volume 718.27K. The market cap is 6.23 billion US dollars. Year range was 61.62 to 80.44. Day range is 70.28 to 70.87. Its previous close was 70.66. Now let's go a little bit further into these guys. So now this is my complete counterexample to IVR, AGNC, NLY, and ORC. So it's everything that you like, that you want. So 2015, there is an increase in revenue. 2021, this is in millions US dollars. 69, 2016, 91, 2017, 111, 2018, 137, 2019, 187, 2020, 248, 2021, 339. Increase in revenue and consistency. They are consistent. Their revenue is going up. They're well diversified. Now we're going to jump to their dividend history. We'll start in 2017, 51 cents and 52 cents, 2018, 54. Quarterly dividend, 56, 2019 to 57 and to 59. Then 2021, right here, 62 cents to 21 cents. So think about that. Quarterly, 20, 40, 60, 21 cents to 22 cents to 23 cents. Okay, they're at 23 cents in 2022 to 24 cents in 2022. Their payout ratio is 74%. Number of dividend increases in the last 5 years is 11. Dividend growth in 5 years is 6.72%. The yield is 4.08%. So if you bought one share, you made $288. So I plan on rebuying Agree Realty Corporation. Going to be adding it to my M1 Finance dividend portfolio. I absolutely love these guys. So I had to do a little bit of fixing with my M1 Finance dividend portfolio so I can incorporate these guys because I want my quarterly dividend stocks specifically to buy stocks like Agree Realty Corporation. And I'm debating if I should add STAG on my M1 Finance dividend portfolio and make a little combination thing so that I can start earning excellent passive income, monthly dividend income, or if I should go on E-Trade and individually invest them. It's actually a really good headache to have with this right now. So you're seeing first of all, they're doing well against the S&P. Their revenue has gone up. Their dividend trends have gone up. So you have to study everything before you make the call. So don't always chase yield. And I'm going to give you one last example of a dividend stock that I absolutely love in the mortgage-backed real estate investment sector. And hopefully putting together this whole video, everything's correct because it's going to be a lot of mixing and moving around. So let's check that out. And don't get me wrong. This could blow up in my face, but I like the model of these guys and how they are as a company, as a mortgage-backed real estate investment trust. Arbor Realty Trust sitting at 14.42, a dividend yield 11.08%. Still have to study these guys. PE ratio 8.77, average volume 2.25 million, market cap 2.48 billion US dollars. Its year range is 11.16 to 18.88. Day range is 14.44 to 14.66, and its previous close is 14.64. So I'm hoping to earn about, on the 30th, about $200 worth of quarterly dividends with these guys. So I'm excited about that, but I'll review these guys. So they offer a total of nationwide solution for multifamily finance needs, including Fannie Mae, Freddie Mac, FHA, bridge loans, and among many other flexible options. Fannie Mae, small loans, CMBS, mezzanine, and preferred equity, single equity rental, Freddie Mac, bridge loans, FHA, multifamily, senior housing, healthcare, and green financing. So let's study their dividend history real quick. So in 2012, it was 8 cents to 10 cents. And then 2013, it was 12 cents. Then 2013, it was 13 cents. Then 2015, it was 15 cents. Then in 2016, it was 16 cents. In 2017, it was 18 cents. Then 2017, 19 cents. 2018, 21 cents. To 25 cents. Then 2018, 27 cents. Then you get a special dividend right here of 15 cents. Then 2019, 27, 28, 29. And then 2020, 30 cents. And then to 31 cents. To 33 cents. Okay. Right here in 2021 to 34, to 35, to 36 cents in 2021, to 37, to 38, to 39, to 40. So the payout ratio is 73%. Number of dividend increases in the last 5 years is 17. Dividend growth in 5 years was 13.14%. So 10.93% dividend yield sitting at 160. Now this one is still a risk. I'm still going to, do my due diligence. I'm taking a risk buying these guys. I'll go over their revenue too. Now with these guys, I have a better shot for dividend hikes. And don't get me wrong, mortgage-backed real estate investment trust, when things go bad, things can go bad. But I'm not going to completely rely on these guys because I don't have all my eggs in one basket. And I'm well diversified with my real estate investment trust portfolios. 2015, 142. 2016, this is in millions US dollars, 213. 2017, 346. 2018, 484. 2019, 535. 2020, 603. And then 2021, 799. So you have an increase in revenue. Remember the rules of a real estate investment trust: 90% of what they make go back to investors. So this is my highest yielding dividend stock that I have a lot of shares in. And I plan on maybe getting to 1,000 shares in these guys. Now I'm thinking about that. And maybe I can buy my other quarterly dividend stocks in M1 Finance with this dividend income. So, I get nice hikes. I get to a nice amount of revenue. And my gosh, these guys can buy me other dividend growth stocks, or it can just be nice passive income. Because I have a goal, $2,000 to $4,000 a month on my quarterly dividends, $1,000 to $3,000 a month my monthly dividends. So imagine even just all that dividend income from these guys going straight into like Stag or Agree Realty Corporation. Like I said, I'm going to be buying these guys. I want to make $1,000 to $3,000 a month on my monthly dividends. So imagine the income from these guys just buying other ones. So I hope you enjoyed this video. This is a long lecture that I made. I will have a video for you tomorrow, but I wanted to provide to you an example of investing mistakes that dividend investors make. I provided 3 examples of dividend stocks that you guys wanted me to do a review on, and I provided actually 2 counter examples. So this is a long video, and hopefully I did it correctly, and that would look pretty bad if I didn't correct it, or if I made these changes incorrectly while I was doing this video. So if you're new, make sure you hit that notification bell so you don't miss future videos. And again, thank you guys so much. We're almost at 11,000 subscribers, so make sure you subscribe, hit that notification bell. And as you always know, this is not financial advice for entertainment purposes only. Disclaimer in the description. I'm showing you my dividend investing journey and what I'm doing to earn passive income and have some nice passive income while I retire. So now it's becoming a possibility that I can retire on dividend income because of the income I'm making as a travel nurse. So I'll go over that actually tomorrow, of money that I'm stuffing into my dividend portfolio. You guys take care and have a good one.